As of Friday, April 4th, the stock market is officially in bear market territory, with the Nasdaq alone losing over 21% from its most recent high on February 9th, wiping out trillions in investor wealth. But will we recover, or is the stock market trending lower for longer? History shows us that the best trading days often come immediately after the worst crashes. In fact, 24 of the 30 best market days in the last 30 years happened during periods of market distress. And if you miss those recovery days, you could be leaving life-changing money on the table, not to mention doing the opposite of the age-old idiom, buying high and selling low. So how can you make sure you catch these critical recovery days? Let's look at what market data tells us about investor behavior during crashes and the surprising patterns that emerge. These insights might completely change your approach to how you handle and perceive this market volatility. Now, the recent market plunge wasn't just a random blip on the radar, it was a culmination of warning signs that have been flashing for months, while most investors were too focused on market highs to even notice. Now, when we look beneath the surface, what we're seeing now makes perfect sense, because the bond market was trying to tell us the story long before stocks took their dramatic tumble. Now, for months leading up to the crash, the bond market, often called the smart money market, was sending very clear distress signals. You see, while everyone was celebrating stock market records, something concerning was happening with long-term US interest rates. They weren't rising as you'd expect in a strong economy, they were actually plunging. Now, this divergence between stock market optimism and bond market caution created an unstable market situation that was bound to correct itself eventually. You see, the corporate bond market was particularly revealing. If you were paying attention, you would have noticed the widening spread between high-quality corporate bonds and risk-free treasury rates. Companies were being forced to pay higher interest rates compared to government bonds, which is a classic sign that lenders are growing increasingly worried about the economic backdrop. Now, this wasn't yet signaling a full-blown recession, but it was definitely showing that economic conditions were deteriorating. And what makes the situation particularly interesting is how perfectly it follows historical patterns that most retail investors tend to ignore. You see, market corrections, which is a drop of more than 10%, aren't that rare, and they're not black swan events. They're actually incredibly common. In fact, since the early 1980s, the S&P 500 has experienced significant drawdowns of at least 5% to 10% in virtually every year except for 1995 and 2017. That's just 2 years out of 4 decades where markets didn't see notable declines. And this statistical reality means that market corrections aren't something to fear, they're actually something to expect and to plan for, yet most investors act surprised when they happen, making emotional decisions at precisely the wrong moments. And the current situation didn't come out of nowhere, it's actually following a well-established playbook that repeats with remarkable consistency. And another factor that set the stage for this correction was the uncertainty surrounding Federal Reserve policy. For months, the market had been pricing in multiple interest rate cuts, expecting the Fed to shift to a more accommodative stance, but those cuts hadn't materialized as expected, creating a growing disconnect between market expectations and reality. And anytime there's significant policy uncertainty, markets become jittery and vulnerable to sharp moves, which is exactly what we just witnessed. And when the tariff announcements finally hit, they weren't just another news headline, they were the catalyst that pushed an already nervous market over the edge. And the resulting decline wasn't merely about tariffs, it was the culmination of all these factors creating the perfect storm. And that's why we saw the S&P 500 and other major indexes experience their worst single-day performances since the early pandemic days of 2020. The real question we should be asking now is more profound. Are we already in the early stages of a recession that most investors haven't even recognized yet? The evidence points in a concerning direction. The bond market has been pricing in economic weakness for months before stocks finally caught up to reality. And this isn't unusual. You see, bonds frequently anticipate economic shifts well before equities responds. Think about it this way. Stock markets often remain optimistic until concrete evidence of trouble becomes undeniable. Bond markets, on the other hand, tend to be more forward-looking and sensitive to economic changes. And when these two markets tell different stories, history suggests the bond market is usually right. And the recent stock market adjustment may simply be the equity market finally acknowledging what bond investors have been seeing all along. Now, this wouldn't be the first time stocks have been late to recognize economic reality. In previous cycles, the bond market has provided early warnings months before stocks began their declines, and the fact that these warnings were present again suggests we might be closer to recession territory than most people realize. You see, the market wasn't just overreacting to a news event, it was finally catching up to the economic reality that had been building beneath the surface for months. And what does this mean for investors? Understanding these dynamics gives you a significant advantage. Rather than being shocked by market movements, you can recognize them as parts of a predictable and recognizable pattern, and you can position yourself to benefit accordingly. Because the investors who build genuine wealth aren't those who avoid market corrections, they're actually the ones who understand them, expect them, and use them strategically in order to profit from them. And those those investors who truly build wealth aren't just prepared for corrections, they actually capitalize on them by understanding a counterintuitive truth about market crashes that most people never learn. Did you know that some of the market's absolute best days occur within weeks of its worst plunges? Missing just a handful of these explosive recovery days can cut your long-term returns in half. And market corrections follow surprisingly predictable timelines that smart investors have learned to anticipate. And while the exact catalyst might vary, whether it's tariffs, interest rate concerns, or geopolitical tension, and these will vary from year to year, the recovery process follows consistent patterns that can give you a significant advantage if you learn how to understand them. So let's examine the actual recovery times from historical data for corrections of 5 to 10%. Now, for corrections of 5 to 10%, recovery typically takes only 3 months, and for corrections of 10 to 20%, recovery extends to about 8 months on average. Now, during recessions, markets fall further and recovery stretches can be significantly longer, but understanding this information is critical to your investment strategy, yet most retail investors never factor it into their decision making. The most fascinating pattern is how the market's biggest up days cluster so tightly around its worst down days. And when examining data from the past 3 decades, something remarkable emerges. Out of the 30 best trading days in the stock market, 24 happened during periods of market distress. Consider major market crises: the tech bubble collapse, the 2008 financial crisis, and the COVID-19 pandemic. While most investors remember the painful drops, they often forget that some of the most explosive single-day gains occurred during these exact same timeframes. And this consistent pattern repeats throughout market history. This is why the COVID-19 pandemic market was actually the shortest bear market in history at only 11 days. And when markets experience severe declines, they reach points of extreme pessimism where assets become significantly undervalued. Then even a slight shift in sentiment or a modestly positive news story can trigger massive upward moves. These are violent snapbacks that happen with almost no warning, making them impossible to time reliably, kind of like what we saw in this past week. Now, this explains why going to cash during downturns and waiting for things to stabilize destroys long-term returns, because by the time things feel stable, you've already missed out on some of the best up days and the crucial recovery days that make all the difference. And this pattern explains why study after study confirms that investors who remain fully invested through downturns consistently outperform those who try to time the markets. They capture those handful of explosive days that occur unpredictably during periods when most people are too scared to invest. And you might be asking yourself, if these patterns are so predictable, why don't more people take advantage of them? The answer is simple but profound: emotions. When markets crash, our brains flood with stress hormones that impair decision making, and we basically become hyper-focused on avoiding further losses rather than positioning for the recovery that history shows us virtually comes every single time. And the investors who build real wealth understand this psychological barrier, and they create systems to overcome it and simply don't sell. They prepare mentally for the corrections, they maintain cash reserves specifically to deploy during downturns, and they stick to their regular investment schedule regardless of market conditions. And by understanding this counterintuitive nature of market crashes, they're able to turn what most see as disasters into opportunities for extraordinary growth. And another thing that's worth mentioning is if you're interested in any of the merch featured on this channel, like the hoodie I'm wearing right now, there's a link in the description for your convenience. It's all entrepreneur and finance themed merch, and honestly, I just created the website so that I could make stuff I like to wear. Anyways, that's all. Back to the content. Now, the psychological barriers that trip up most investors are exactly what create opportunity for the disciplined few. When you see the market dropping and your instinct scream, sell everything, that's exactly when the wealthiest investors in the world are making their biggest moves in the opposite direction. This counterintuitive approach forms the foundation of real wealth creation that happens exactly during these market downturns that most people run from. And Warren Buffett's famous advice is to be fearful when others are greedy and greedy when others are fearful. And it isn't just a clever saying, it's the actual playbook he used to amass billions. You see, during the 2008 financial crisis, when banking stocks were in free fall and investors were abandoning ship, Buffett took decisive action and he invested $5 billion in Goldman Sachs, securing preferred shares with a 10% dividend yield, along with warrants to purchase common stock. And this strategic move ultimately generated over $3 billion in profit for Berkshire Hathaway. But here's what makes this approach so difficult for average investors. It requires you to do exactly the opposite of what your emotions are screaming at you to do when markets collapse. You see, when markets are plunging and financial news headlines are predicting doom and gloom, your brain's fight or flight response kicks in, and although this primitive survival mechanism served our ancestors well when they were fighting off predators and tigers in caves, it works against us when we're in the financial markets. And the wealthy know this, and they've trained themselves to recognize these emotional responses, to act as signals to act, not retreat. Now, the strategy itself isn't complicated. It involves two key components. First, buying quality investments at discounted prices during market crashes, and second, continuing to dollar cost average through the downturn. Now, this approach turns market fear into genuine opportunity for those with the discipline to execute it. You see, Warren Buffett views cash not as a dead asset, but as financial ammunition to be deployed when opportunities arise. And while many investors holding cash see it as a missed opportunity during bull markets, Buffett transforms this potential liability into a strategic advantage during crashes. And this is why he maintains substantial cash reserves specifically to capitalize on these rare market dislocations when they appear. And in recent times, as markets have experienced increased volatility, Buffett has been keeping a record cash stockpile, demonstrating his preparedness for future opportunities like the one we just witnessed. Now, what separates Buffett's approach from typical investment strategies is that he focuses on business fundamentals rather than market fluctuations, and he applies a straightforward test during market downturns. Does a 30% drop in share price affect the number of Cokes people will drink next year? If the answer is no, the intrinsic value of the business remains intact regardless of the market's temporary sentiment. And this principle explains why Buffett has held companies like Coca-Cola for 36 years and American Express since the 1960s. When you purchase ownership in business with strong fundamentals and competitive advantages, temporary price declines become opportunities rather than threats, and they start to matter less and less. You see, the market may misprice these businesses in the short term, but their intrinsic value remains unchanged. And the current market environment presents exactly this type of opportunity for investors who can remain rational while others panic. You see, when quality companies with strong balance sheets and proven business models suddenly trade at substantial discounts, smart money recognizes the disconnect between price and value. They see what others miss, that fearful markets often misprice fundamentally sound businesses. Warren Buffett has famously said, the stock market is the only place where people freak out when everything goes on sale. And another critical aspect of this approach is avoiding the temptation to time markets. You see, Buffett doesn't try to predict exactly when markets will bottom out. Instead, he focuses on buying businesses at prices that provide a margin of safety. And this patience and long-term perspective have been central to his success through numerous market cycles and economic crises. And the smart money also recognizes early warning signs that most investors miss, because before the recent stock market decline, bond markets were already signaling trouble. Early indicators like falling long-term interest rates as well as widening corporate bond spreads were flashing warnings, and sophisticated investors were positioning for economic weakness. While casual investors were still celebrating stock market highs, these bond market signals were providing valuable advance warning of the turbulence to come. And by understanding these signals and following the smart money playbook, you can transform your market crashes from periods of loss to powerful wealth building opportunities. The investors who truly build generational wealth aren't those who avoid market crashes. They're the ones who use these inevitable events to their advantage by buying quality at discount prices when everyone else is selling. So what should your mindset be as we navigate these turbulent markets? Become what Tony Robbins calls an unshakable investor, someone who sees bear markets not as disasters, but as rare opportunities, because this is exactly when you should be deploying your cash strategically or rebalancing your portfolio towards quality assets that are trading at discount prices. Remember that market downturns are temporary disruptions in the long-term upward trajectory of markets. When others panic sell and prices crater, that's precisely when wealth-building opportunities emerge, just as Warren Buffett advises to be greedy when others are fearful and fearful when others are greedy. Your future self will thank you for having the courage to act when everyone else is running scared.